This is Friday the 13th, so it's a very interesting day to do our session. Usually the stock markets are all very spooked about this. Also, there's a huge amount of myth and superstition associated with doing fundraising. First one is I just wanted to lay out the whole enterprise life cycle. And what you have in the very beginning is an inception stage where you have the idea, concept, and then you actually take the concept and make a proof of concept, and that's where you have the prototype stage. The third stage is a rollout stage where you actually have not just developed it for 2-3 people, but it's actually rolled out for the entire market, and that's called the rollout stage. And then you have growth. So if you have, let's say, 1,000 people using it in the rollout stage, the growth is actually where you're going for tens of thousands of millions of people, and that's really the growth stage. Then there's the expansion stage where you have pretty much figured out how this thing works for a product in a particular market, and you're now going to different markets and different products. And then finally, in that particular product category, there's a saturation, a maturity, and therefore the revenue potential for that starts saturating or plateauing out, and that's the maturity stage. Now obviously companies go beyond that, and what they do is they add more products and they add more categories. Therefore suddenly that doesn't plateau out anymore but continues to grow. Now as you can well imagine, in the very early stages, the company is full of risk, and therefore the kind of investments that you will be able to attract are not as many as you would in a much later stage. But having said that, let's look at what are the different risks that are associated with the enterprise at that time. So the first one is technology risk. So technology risk is where you have the concept is still in your head. It's not there in the real world, and therefore people are wondering indeed if this idea that you have will work. So it's still a red at that time. And again, most of us as technologists assume that once you build the technology, there will be a market out there. People will come and knock on your doors and buy your product at the price that you have put up there. And sometimes it just doesn't work that way. The market is thinking very differently, and therefore when you put the product out there, there may be not much of a demand for the technology that you have put together. So the market is something that has been unproven, and therefore the market risk is not mitigated at that time. Execution is where you actually are rolling out the company, the product, into a much larger market, and therefore the set of people who actually built the product, are they able to now not only market it to the first 3 or 4 or 100, but are they able to do it for the 1,000 and the 10,000? So that's where the execution capabilities of the company come into light. And finance is where you actually are raising money again and again, sometimes in equity, sometimes in debt, but you continue to raise money. So these are the risks. Are you able to do that consistently is the question in the finance risk. And what, as you will see in the life cycle, it never gets mitigated. Maybe at the end, when you really do sell the company and move on, the company is done, and you are, as far as you're concerned, your finance risk is zero. But the company, is still not completely in the green in terms of risk. It may or may not have happened, the transaction that you just underwent. But anyway, so as you can see, red means highest risk, yellow is somewhere in between, and green is the risk is pretty much under control. So in the very early stages, the kind of people that come in and invest are angel investors. In between inception and prototype, and between prototype and rollout are seed investors, and when the rollout has happened, there's venture capital, and then it goes on to several rounds of venture capital, maybe private equity, and maybe banks are also very, very apt to put in money at this point in time. And then finally, you go into an IPO acquisition as the ways of raising money as well. So this is kind of the life cycle of how companies can raise money. So if you have to be very clear for yourself, since most of you, 50% of you said you are not profitable yet, that you probably are on the left side um, of the graph, and then if you're profitable, you're tending towards the right side, and therefore the options that you have for investments are growing. At the same time, you also need to understand the motivations of the people that are in the investment category. So the angel investors are coming in at a very early stage. They understand the industry, they understand the risk associated with the startup, and they're willing to help out not only with money but also with their own time, and therefore they are willing to mentor you as well. Several of the mentors in MentorSquare are themselves on an individual basis in investors in some form or the other. And then the seed investors do it at a different level. Venture capital are institutions that have raised money from someplace else, and their charge or mandate is to find companies, good companies, invest in them, and create 10, 20 times the original investment that was put into the company. And then later on, the private equity are similar to venture capital, except that they don't have 100 times, maybe 5 times, maybe 6 times, maybe 10 times is the mandate, and that's a kind of aspiration that they have. So that's the motivations why these investors come into the picture. So having explained this one, if I go to the next slide, what becomes quite apparent is, even if it's a debt investment, it is the same. We look at the same curve, and the kinds of money that you can bring in at the inception prototype stage is very, very limited. It is usually government backed, because the government is the one that will step up to taking on this kind of risk. So there is a credit guarantee insurance that a government agency will be able to provide. Later on, there is project finance, there is term loan, there was working capital loan and expansion loan. But all these things are always tending towards the right rather than the left, because there's not a whole lot that happens in the early stages in terms of debt. There's a lot of talk about the government stepping in where there's no real business will come in and be able to realize the kind of returns that a business needs to have. So you're right. So when you have a SIDBI or a bank that is coming in and saying, I'm going to step in and I'm going to do the financing, the kinds of evaluation techniques that they use to decide on the financing, the kind of understanding that they have of the market, the kind of understanding that they have of what does it take to build this business forward, obviously is limited to the people that are evaluating it. And even though they are willing to come in, they are still bankers at the end of the day. Appetite for risk is very limited. So if you go by the official line, they will say that they will come in at a stage where not many institutional investors or other investors will come in, but at the same time they also are saying they would like to see something different. So it's kind of a little so what is different is something very hard to decide. But the good news is SIDBI in their wisdom have realized that they need to work with organizations such as MentorSquare, and they've been asking us not only to help them find those good companies that they should be investing in, but at the same time, having invested in them, mitigate their risks by having MentorSquare continue to mentor them in their journey, so that they can actually get to the kind of returns that they are looking for as well. The other slides. Okay, so if you look at all the different options that you have ahead of you, if you just map them out, equity, you have angels, seed funds, VCs, PEs, corporations, partners. Now, corporations and partners I didn't talk about earlier, but there are times when a company does not want to develop the technology themselves because they feel that there are so many things that have to be figured out, like what you saw in the risks, the 4 risks. So they're saying, rather than me, than us, who have already got a quarterly revenue targets, and we have already got a lot of customers that we need to take care of, why don't we just become an investor in some company that looks promising, could potentially become a product that we will carry in the next, say, 3 to 5 years, rather than us investing in an R&D and a marketing team to do all the things that we need to do internally in the company. Let's do it outside of the company. So let's just go ahead and put in some amount of money, let them get started, let them go make things happen. And if they really catch on and make things happen, then we will roll them in some fashion or the other. So that's usually the thinking of a corporation, because they want to test the market without really you know, uh, diverting their resources in a big fashion to do that. Cisco is very, very good at doing this, and they've done extremely well in employees who have great ideas, don't want to do it within Cisco, but want to go start companies. They will try and partner with them, and then when they have built the venture to a certain extent, spin them back in. So it's a spin out and a spin in that they do extremely well. There are also other partners who actually look at this. So hospitals will try and invest in bio tech companies or pharma companies, just to give them that kind of diversity that they are looking for. And various other partnerships also have emerged. In the debt, obviously we have friends and family, we have project finance, banks, overdraft facility, a lot of the state finance corporation, development banks, venture banks, and so on. So there are several options that are available on debt, because debt is a well understood, well supported, well collateralized instrument. So a lot of people like that, and there are lots of agencies that are willing to work in that area. Now, wherever neither equity nor debt is willing to take a chance, the government steps in, and they are willing to, through some agency or the other, provide grants and subsidies and in-kind investments. So that's what happens. So if you were to have a set of options, let me skip 2 slides. Obviously, what you would like to do is see if you can generate the cash within the company to fund all the growth activities that you want. But if that's not possible, to see if there are any grant possibilities as the first option that you want to look at. And then the second option is, if you don't have grants that will fund you, then look at debt instruments that you can bring in. Although debt looks like a onerous thing, there is an interest rate, and then the government or the bank will ask you for reports every once in a while as to how you're doing, and so on and so forth. It is less expensive than an equity, because at the end of the day, in terms of your equity holding, you only can hold 100% of the company. So if the other people are holding 20%, 25%, the amount of holdings that you are going to have available going forward is very limited, and therefore the limited equity may or may not be appropriate for all the players that are involved with the company. So equity is the most expensive way of raising money. So you want to try and stay away from it as long as you can. Try doing debt, or try to fund this yourself, or get grants, which will be the least onerous on your company in the early stages. And then let me step back. We want to make sure that you understand that capital is only one aspect of building the business. It's not the entire aspect. And a lot of times I come across companies that say, only if I had money, I know I can figure everything out. it's only the money that is actually holding me back. Otherwise, I would have done extremely well, and so on and so forth. Indeed, that's more a skewed way of looking at things, I feel, because if you do have a great company, if you do have a great business plan, if you do have a great team, and you're doing extremely well, there's a huge amount of investors that are actually looking for these kinds of companies. They'll come knocking on your door rather than the other way around, which usually becomes the case because you feel that you need to raise money at different times. So as long as you keep that in perspective, that if you do have a great great play, if you say, then there will be a lot of people who actually want to become actors in your play, and one of the actors in your play would be an investor. And you need to be able to orchestrate your company in that fashion. The second one is not all companies actually do need capital. There are lots of companies that have become extremely successful in the IT world and outside, which have not raised any money at all outside of themselves. They have generated pretty much all of it internally and grown extremely well, and are now the top class, world class companies. Venture capital, as a lot of the mainstream media or business media would tell you, is the way how you measure how many startups are coming up and so on and so forth. Indeed, is the beginning of a very different journey. So before you take on venture capital, you need to understand that what they are going to try and do is help or want you to grow extremely fast. So if you don't have your early set of questions taken care of, then obviously you will find out that you can't be fixing those problems, answering those questions when you're already trying to grow as per the venture capital's requirements. Sometimes bringing in the capital will also kill the company. As much as people say that's the only missing point, actually it could also be the reason why the company cannot go forward, because the people that get associated as investors may actually have unrealistic expectations of the entrepreneur. And then if they have expectations or their own requirements are completely different from the entrepreneur, then the company starts having more conflicts than actually alignment, and therefore that this could indeed create much more problems than it should have if they had not raised the money. So it's important for you to keep this in mind, that it's not money that can solve all the problems. It can actually create more problems if you don't really orchestrate the fundraise in the right way. And then the final slide I would like to go to is the milestone based approach, which is in equity and maybe for a large extent debt as well, is for you to actually look at your companies as actually a whole series of steps that you're climbing to actually get to where you need to get to. So every step is very distinctive, in the sense that the first step is not like the second step. So if you are looking at the first step where you have two solid technology founders, where the one in orange, to the second step right here in the middle, they are completely different stages of the company. It's a transformed version of stage 1 to actually get to stage 2, and from getting to stage 2 to stage 3 is a completely transformed version. So indeed what you will also then recall is, if you map this back to the risks that you saw underneath the graph, that indeed in the first stage here you actually have a company that is pretty much in the inception stage, and this company, the same company, has now gone past the inception stage and become more of a prototype stage, and then finally you're here more at a rollout stage, right? So you will find that there is a distinctive nature about the company, and therefore if you really are trying to go from one transformation, one step to the other step, the company is actually uh, gotten a whole lot of risks mitigated to get to that step. And also, these are the right times to bring in the capital. And so if you tell the investor that I'm actually going from this step, the first step, to the second step, and this is what I will accomplish with this amount of funds that I'm going to raise, then it's very clear as to what the funds are for. And then when you do reach that step, the investor is happy, you're happy, and then finally everybody seems to say, okay, now on the basis of this, now we're ready to take on the next set of challenges to go from step 2 to step 3, and therefore makes for a very clear set of expectations that are set, and a clear set of expectations that are met, and therefore gives the investors, gives the entrepreneurs the confidence to move forward in a more decisive way. And at the same time, it also gives the entrepreneur an opportunity to actually raise only that much sum of money that is required at that point in time. So for example, a lot of times when I see entrepreneurs coming to me, they will say, you know, I need 20 crores, and they just are a PowerPoint presentation stage company, and I'm wondering, why would they need 20 crores? But they will say, yes, I need 20 crores over the next 5 years. But again, that may be true, that may be not true, that may be completely off, or it may be too little for what they're trying to accomplish. We don't know. But what we can do is, if they are at the PowerPoint stage, the stage 1, is to actually say, okay, if you really were to actually build this technology and deploy it and take it to the next 2-3 customers, how much money would that take, or how much time will that take? Now that's a fairly well contained question for them to answer, and they can go back and do some homework, talk to their technical people, talk to their potential customers, talk to whoever they need to talk to, and then they may come back with answers that will give them a fairly good idea. And then they may say, you know what, I really need only 6 months to get from stage 1 to stage 2, and I really need only 30 lakhs, and I should be fine. Now that's a a fairly nice story to actually take to an investor and say, I'm raising 30 lakhs, and for those 30 lakhs I'm going to get from stage 1 to stage 2. That's a buyable story. Some investors can buy into it. They can see exactly how this is going to happen. They will see the evidence of the entrepreneur's words within 6 months. And the amount of money that has been raised is not a whole lot of money from an investor standpoint, and from the entrepreneur standpoint. So the risks are also well contained from both sides. And if I really look at an entrepreneur who has come from a corporate world to an entrepreneurial world, he needs to know what he's going to do when he wakes up in the morning. Now it's very clear that within 6 months he has to get to stage 2, and so there is a very clear set of milestones he needs to meet, and therefore he will work assiduously with his team to make that happen, and make very frugal use of the money and get there. So that's an approach that we at MentorSquare are continually trying to inculcate in our entrepreneurs, so that they can continue to do this very clear, well understood, milestone based fundraising. So this is my last slide. I do have one other slide, but I just will leave that on just so that you know that these are the kinds of questions that you will eventually have to answer to raise the money. But all this comes fundamentally from the slides that I just talked about, as to why is it that you need to raise money and how you need to raise money. But once you start thinking through all that, it becomes quite easy for you to actually build the business plan and all the sections that you see here. I won't confuse you with this. We can always talk about this separately. If you want to talk to MentorSquare and any of our mentors, we can help you develop these kinds of chapters for your business plan. But more fundamentally, I think you need to understand that as long as you are well informed as to where you are in the stage of the company, where you are in terms of maturity and the quantum of money that you want to raise, and what are the options that are available to you, I think we would have accomplished quite a bit in this particular talk in addressing those things and giving you that clarity. So with that, I'll close my presentation part, and I will open it up now for interactions. Thank you very much for your time and your patience. And if you need any other specific questions answered for you, just go ahead and write to info@mentorsquare.com or send it directly to me at ravi.narayan@mentorsquare.com. Thank you very much.